John Paul Smith, emerging market strategist with Deutsche Bank, joins us with his take on global economy. John, you have been bearish on BRICS. With these economies now slowing down and facing structural issues, do you still think one should avoid emerging markets, especially BRIC economies?
We've been bearish on the BRICS in absolute terms and relative to developed markets, especially the US, for about 3 years now. And obviously over that period of time they've underperformed a great deal. So there's sort of two pieces of good news really as far as the BRICS are concerned. The first one is that the valuations of those markets, particularly on asset value or replacement cost measures, are a lot cheaper. I mean, Russia is by some distance the cheapest market in the world. Brazil and China are not that far behind, and India, whilst it looks quite expensive at 2.5 times book, is actually very cheap against its own history. The other piece of good news is that the sort of hubris amongst policymakers has completely evaporated now. So in other words, policymakers in all 4 countries are well aware of the need to both pass and, more importantly, implement structural economic reforms to revive the sort of underlying rates of growth. The bad news, however, is that we think that the situation in China in particular could still deteriorate quite a lot from here, and we're especially concerned about the build-up of inter-enterprise debt, which we think longer medium term threatens the viability of the entire economy. And of course, if there is some sort of adverse financial development in China, then that will have repercussions for the whole of the emerging market universe, but particularly those markets which are more dependent on Chinese growth and more dependent on commodity prices, and would certainly include Brazil and Russia in that category. So we're still outright bearish on 3 of the BRICS, namely China, Russia and Brazil, and sort of slightly ambivalent on the 4th, namely India. And in India, which we'll get to in a minute, I guess the election outcome will be absolutely critical to where the market goes from here.
You mentioned that you have a bearish opinion on emerging markets, and within emerging markets you are bearish on Brazil and China. But emerging markets surely got a breather when US Fed decided to skip tapering in the month of September. But many experts also believe that this is just a lifeline because eventually tapering will happen. What are your thoughts on global liquidity?
Well, volatility will certainly return to emerging markets, but I think that's got more to do with the situation in China and much less to do with tapering. I mean, in a sense, the tapering scare was always nonsense, because what we see in emerging markets, or emerging economies rather, is we see a downgrading of growth, continual downgrading, almost across the board. Admittedly, recently in China, people have got a little bit more optimistic, but we don't think that situation is sustainable. And of course, that weakness in emerging market economies then feeds back into developed markets, which was one reason why the Fed decided not to implement the taper. So we're less concerned about the future actions of the Fed and much more concerned about a potential further deterioration in the emerging market economies, particularly in China.
John, so how do you see Indian markets performing in the coming quarters, or do you see more volatility in store?
Well, yes, we think there will be more volatility. The market is, as I said, relatively cheap to its own history, but what that conceals is a big bifurcation in valuations between, on the one hand, some very, very well-run, predominantly private sector companies with relatively low debt levels, often in the staples or consumer discretionary sectors, which, as I said, are on relatively high multiples, and then debt-laden conglomerates and state-controlled banks, which justifiably are on low multiples. So overall, there's no particular valuation-driven reason for buying the Indian market at the moment, particularly given the fact that the structural rate of economic growth, for the time being anyway, has come down, and that's what share prices are currently discounting. So we think the oil price will be a key driver, and we also think that the perceptions as to the election result will also be a driver, and both of those factors are likely to cause some volatility.
So John, how exactly are you approaching Indian equities then? Are you buying this market on every decline? If you're buying, where are you hiding?
Well, the history of the Indian market over the last couple of years is that it's paid to take a relatively contrarian approach. I mean, our view at the moment, given the lower rate of economic growth in India that we're likely to see for the next couple of years, is frankly that the market's fairly priced. So in that sense, yes, if you see sentiment improving a great deal, perhaps as speculation increases of a more decisive outcome to the election, then that might well provide an opportunity to lighten positions. Similarly, participants in the Indian market, both international and domestic, have a fairly manic approach and a history to getting overly depressed at the wrong time as well. So if we see a further big sell-off in the market, like we saw in July and August, then that will be an opportunity then to increase holdings. At the moment, we don't have strong sector preferences, and in fact it's a very difficult decision to allocate resources within India, simply because you do have this very sizable bifurcation of valuations between, on the one hand, very lowly valued state-controlled banks, state-controlled companies, and also very highly indebted conglomerates, and on the other hand, companies with much better governance records and much lower debt levels. So I think that's a relatively difficult position, and we'd actually be relatively close to the index in an Indian portfolio at this point in time.
John, really appreciate your time, and I'm so glad you could accommodate this interview request.